Good morning. This is Ken Long from Tortoise Capital with the review of the weekend trading report for August 10th, 2013. We have a market that is bullish quiet still. On an annual basis, it is 68 out of 100 on weekly RSI 14 in the high end of neutral. It's right in the middle of the 10-day trading range with a 10-day NDX reading of 52. Looking at the market mosaic, percent stretch relative to the 200-day moving average has pulled back into white bullish at 10.36%. The slope of the 50 still yellow neutral at 0.31. ADX has dropped to 17.9, so losing its trendingness. The ATR percentage remains very quiet at 0.74%. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, is almost at parity at 1.06, or risk on is still in place, but it's declining, as you can see in the time series of the last 90 days. As a point of reference, we've seen large VIX spikes after periods of extreme quiet and then volatility increasing. When that crosses around the zero line, has been moments when we've seen sharp VIX spikes in the world. It doesn't happen every time, but every time it's happened, there's been that sharp move from the green to the red. So as this approaches the danger zone here, we'll be cognizant of that. The risk Z, which is the standard deviation of that reading, is at 0.65 on a long-term historical basis compared to the last 5,000 trading days. No change to the blended monthly rebalancing portfolios, with the next reeval due on or about 1 September. The ETF2 theoretical model remains at 70% exposed. The model portfolio is at 80% exposed, and stops are updated. Just a quick review of the top holdings in the current blended monthly rebalancing computations. Small caps, tech, and mids in the 13. Discretionary healthcare and the small caps in the 32 ETF portfolio. Both have about half, slightly over half on a buy signal, vice at close cash signal. Looking at the market health check, the river slope is up. The price has just re-entered the river, coming out of an extended period in the floodplain. This is a natural place for it to find support above the Bollinger Band mean. The 30-period regression line lagged one day, still sloped powerfully up, although it is starting to decay a little bit, as you can tell by the time series of that slope function, which is this sine wave. I still treat this 170 as about the swing high. It's got to really stay above the Bollinger Band mean, close above 170, and continue to go. Then we would see this 168 as being support level. But that's the challenge to the market right now, is to maintain some strength here after this almost 22-day period of consolidation. Excuse me. You can see the decay in ADX. It's still relatively low. Bulls are slightly in charge. We've come out of oversold conditions on the Williams percent R, right back to the midpoint. The jaws of PPO are open to the downside and warning about an intermediate top here. 3 of the 10 indexes are on cash signals for the ETF2 strategy model, and this should read 70 and 30 invested in cash. Sorry. The S&P is still better than EFA. Small caps, mid caps, large caps, then tech. 2 strongest small caps and mids, 2 weakest Latin America and emerging markets, or Asia less Japan, excuse me. All of the sector spiders look really good. The strength is in and remains in financials, healthcare, and discretionary. World market model, everything in the U.S. is above average, especially the small caps, excuse me. China continues to dominate, as is oil. It's getting a little toppy in oil. Private equity remains strong. Everything Europe is above average, Netherlands exceptionally so, Latin America, emerging markets, the rest of the Western Hemisphere exceptionally below average. Gold and silver continue to lag, although they have shown some interesting behavior lately. That looks pretty good. All of the U.S. Business sectors are equal to or better than their global counterparts, with the exception of utilities. Real strength across the world in discretionary, healthcare, and finance. Little to no change among the ETF top 30. Remains solar, clean energy, banks, pharmaceuticals, healthcare, lots of small caps. The up-and-comers are those that are green in strength and white in consistency, and so there's been real emerging strength this week developing in the Netherlands, crude oil, and the Alpha Dex index for producers, industrials. The Dow 30 through that same lens, up-and-comers looking at Merck. Some price decay here in Home Depot, Microsoft, and Disney, which are white on strength and green on consistency. Even the worst performers in the Dow, however, are at least in the yellow on strength, so that's good. IBM has now taken up position in the bottom, bumping Caterpillar and Alcoa, who've been our two long-term laggards. Interestingly, Alcoa and Caterpillar are on a buy signal with respect to their 4-month moving average, so that's really to take notice of. We may see some strength there. We saw it in the Alpha Dex industrial producers. Maybe this is the time for Alcoa and Caterpillar to have turned the corner. Let's keep an eye on those two. We like them when they turn the corner and then start that long march back up to the top. Think about Hewlett-Packard when it was down at 11. ETF liquidity, just for reference. A handful of symbols in the auto framer and then also on 551W patterns. Oil on 5-day down, triple screen for small caps, channeling for financials in the diamonds. Latin America is on a overreaction short signal. If we see market weakness, that's the first place that I'd go and pile on, because that's been so bad for so long that wouldn't take much to make it roll over again. Lots to choose from among the Dow 30, plenty of channeling and overreactions. Excuse me, you get a half a dozen RSI2 values under 10. Some good auto framer rewards to risk. Pfizer should be of interest on a 551W with a 2.5 to 1 reward to risk ratio. I like IBM, Chevron, and Verizon for stalking because of the RSI2 value and the max pain range compression and the auto framer favorable stats, and that they are on channeling and overreaction signals as well. So lots to recommend them to you. Fewer choices among the ETF 30s. Only 3 test out better than 2 to 1 on reward to risk. 1 doji in Japan. IWM looks to be interesting to me, though. Triple screen and 551W on the strength leader, and it's got a 3.1 on fraud quality number, and a 31-cent standard deviation for intraday risk is pretty attractive. Just a quick frame of reference for the auto framer. I won't read the chart. You can see the index rolling over. The power function or the polynomial trend line has crossed back over the straight line 30 period. And the 30 period regression line has crossed its own 10 period moving average at an extended distance from the 6-month average. So that's a sign of intermediate term weakness as an early warning. You can see that same thing on the 180-day chart here. And even on the percent stretch, you can see it was not able to achieve the previous new highs, not to be expected later on in a longer-term bullish market, but it's starting to get weak. And that's a reflection of the weakness of those last 20 days. Fail stats, signal to noise ratio, and Just some more reference charts for you. The 30 has definitely rolled over. The 10 is back to the median on the z-score of that regression line slope. You can see we've come back into the river. This is the place where it's got to hold if we wanted to see this another one of these long climbs. We'd like to see it hold right here, but certainly at the Bollinger Band mean and not later than the bottom of the river. So it's got some work to do here. And the rest are just reference charts for your use. And it's off to soccer practice. This is Ken Long from Tortoise Capital. Take good care. Keep your wrist measured and your powder dry.